Good afternoon. It is Monday the 3rd of June. My name is Jordan Lambert, market analyst at Gelatama Management. Last week was a strange week for gold. It finally broke through 1400 after numerous attempts over a 2-week period, reaching a high of 1421.8 last Friday. And then it seemed as though the bulls simply handed over all their hard work for the bears to take control again, forcing it aggressively back below 1400. Gold's rise until Friday was driven by some uncertainty creeping in regarding growth outside the US, following the IMF and the OECD reports, and the market looking like it was ready to make a technical correction in its bear trend. However, clearly, the majority of shorting participants seemed to be longer term and weren't affected by the $1,400 resistance break, and hence added to their positions, eradicating all the gains within a few hours. Interestingly, dollar-yen, which has had stronger than normal inverse correlations to gold since the launch of Japan's new QE program, also dropped, showing gold fell out of favour despite the dollar weakening, which does not bode well for the metal. We could see some dollar strength this week as dollar-yen finds support at the psychologically important level of 100 yen, and as the market anticipates ECB President Mario Draghi being unable to put any kind of positive spin on the Eurozone's dire recession-hit economy when he speaks after the rate announcement Thursday, which will put pressure on the euro-dollar pair. Therefore, considering probable dollar strength this week, gold might be put under more pressure. Gold's destiny for the rest of the year is very much dependent on how equity markets react to the Federal Reserve's management of tapering the unprecedented stimulus and how they manage market expectations. Gold has already factored in much of the Fed's forthcoming tapering of stimulus, but equities clearly haven't, which indicates equities could do worse than gold when the Fed finally begins to reduce the program. It's also worth noting that if we do see an equity correction, gold may even benefit, contrary to the consensus opinion, as investors diversify and add commodities to their portfolios. From a technical perspective, gold is at a crossroads with conflicting data across different timeframes. The daily chart shows Friday's candlestick was very bearish, engulfing the prior day's gains. However, the 10-day moving average is currently intersecting with the 20-day moving average, which signals possible upward momentum. If we get a crossover from these two moving averages, the bulls' hope of a sustained correction may still be on the cards, although the recent increase in volatility isn't good for the bulls, as volatility is usually associated with bear trends, and therefore any bulls should reevaluate if we see further erratic price movements. This week has a very busy economic calendar, including US ISM manufacturing tonight at 10 p.m, US trade balance data at 8:30 Tuesday, Italian and Spanish services PMI data Wednesday afternoon, and the ECB's rate announcement and press conference starting at 7:45 p.m. Thursday night and culminating in the US non-farms 8:30 p.m. Friday night. Evidence that the US creating more jobs and can feasibly lower unemployment towards pre-recession levels will cause whipsaw effect on gold as investors weigh up the impact on the equity markets. Therefore, trade carefully around this number. Thank you for listening. I'll speak to you again same time next week.